there's a lot of stuff going on. I see a lot of opinions on where things might go in the future. We're going to have a crash. We're not going to have a crash. It's going to be the greatest buying opportunity ever and everything in between. I've got a few opinions myself, but ultimately, when it comes down to it, inventory is low. There's still a lot of demand. A lot of that demand is being held back by affordability, and we're just not building enough. And that's kind of been the story for a while. And not a lot has changed other than the affordability factor, and that's just mainly because of interest rates.
So yeah, let's talk about those three things. You said affordability, inventory, and not a lot of inventory because nobody's building. Well, first of all, and you correct me if I'm wrong, I believe the reason, and we've talked about this in numerous details here at Jet Lending, the reason why inventory is low is because two things, in my opinion. One, during the refi boom, which was 2018 to 2021, or I'm sorry, 19 to 21.
Yep.
Little after COVID, it picked up big time. You've got people in interest rates that are 2.75 to 3.25.
Yeah.
So essentially, for the next 15 years, those properties are no longer on the market.
Yeah, it's like 80% of mortgages out there are below, I think, 6%. And then I forget, I think it's about 70% of those are below 5%. So you have, and then the going rate right now is 7.5-ish. We're talking conventional. That's just 30-year average in the US right now. It's ticked down a little bit, but and then such a large percentage of those are, it's in the 4s, 3s, and then there's a few lucky folks that got it in the ridiculous 2s. But yeah, why would they trade in a 3.25%, a 2.7% mortgage for 7.5? Like, it would take something significant, like a job relocation, or maybe just financial hardship where they just have to sell. But even in that situation, they're probably better off from an affordability standpoint, hit the 2.7% than renting.
Yes, definitely. If anybody's watching this at any point in time, if you're in one of those properties that's a 2.75 to a 3.25, I mean, I'd even go as large as 4%. Right now, you don't sell that house.
No. If it's within that 2-point difference, it's a hard pill to swallow emotionally. But then the affordability factor, like, you have to really need or not just need, you gotta really want to. And that's usually going to be more from job relocation kind of situations.
Yeah. We just got back from an annual conference, the AAPL, Annual Association of Private Lenders, the first day back in the office from being at that convention, and they put out a lot of data stating exactly what we're talking about. Like, 40% of the nationwide, 40% of those mortgages are not going to be moved. And you shouldn't. What you should do is say, hey, if I can afford to buy another house and rent this one out, that is good rental income because it will cash flow. Now, at the same time, if you can't, and like you said, if it's an absolute must that you sell that property, well, then you got to, but I think that's what's got a large number of, the population saying, oh, it's time to pump the brakes. Now, inventory, we talked about that being low. Affordability, you got people, 2-3 years ago that would go out and buy a $700,000-$800,000 house, and those were selling. Now people are like, oh, whoa, pump the brakes. Interest rates have increased by 3-4% during this time. I got to move down in market on what I'm able to afford, because Americans
that part's a little different. I'm talking Houston, and then I pay attention. I live in a pretty decent neighborhood in Sugar Land, and I see homes fly off the market, like at pretty close to list price, and they're 700-800 to $1 million plus. So I think from an affordability standpoint, like, if you've got a good paying job and you're well and affluent, it becomes less of an impact for you than if you're a first time home buyer, or you're in that median to low median income range where it really impacts you. I mean, if you can afford the payments and you can get a home, it may not impact you as much, but the inventory is being hurt by two reasons. We're just not building enough, and there's not enough inventory recycling in the market now. They're just staying put. And then the affordability standpoint, we've had the wage growth has not kept up with home price growth.
Huge gap
over the past several years. Now, the one thing that has mitigated that for a lot of home buyers is interest rates just kept going down and down and down. They did that for like 10 years straight, pretty much. And then during COVID, it collapsed in the twos. So that has been the saving grace for a lot of folks being able to afford a home. But the opposite reaction to that is prices just went up faster. Yes. Now, when you have interest rates triple in 18-month period, something has to give. And that's why we're just seeing if there is a real estate collapse, if there's anything that has collapsed right now, it's transactions. Like we're at a 20-year low in transactions.
Which is hurting a lot of people. I mean, there's you got lenders, whether it be hard money lenders or, long-term 30-year mortgages. I mean, I talk to Clint every day. And, he's like, hey, we're in a rough time. We see it maybe clearing up second quarter 2024. Sorry. But right now, people have they're uneasy. The consumer confidence is really not there as far as your end buyer.